Unit 4 of a 10-part series of personal finance with Business Teacher's Toolkit. My hope is by the end of this unit, my students and your students will be able to determine how financial institutions figure out whether or not they should lend you money. In this unit, students will learn what is a credit score, how it is calculated, how they can check their credit score, establish credit, how can good or bad credit affect them, and what is a credit report and how do you read it. We open by asking students if someone was to grade them on their financial habits, what grade would they earn? I use this as a Pear Deck slide so students can interact with the slide. I use a dragging icon so they can show me exactly what they believe to be, and then I'll show the class anonymously what students are saying so that they can usually get a pulse on where people are at in the room. We open by defining a credit score, which is just a number ranging between 300 and 850 that's assigned to a person so that lenders, when they go to make a decision about whether to lend you money or not, have an educated financial backing decision to be able to see whether or not you are likely to pay them back on time, every time, and in full. This credit score is linked to your social security number and date of birth. So what makes up a credit score? Well, I like to call it 5 parts of the pie. And so this graph does a pretty good job of demonstrating what the 5 pieces are that make up your credit score. These 5 parts of the pie determine your credit score, payment history being the largest of 35%. Do you pay people back on time? How much do you owe? If you have a certain credit limit, let's say $10,000, are you always up against that $10,000? Are you in the lower range, somewhere in between? That helps the lender make an educated decision on whether or not to lend you money. When I'm talking about a credit score or a FICO score, do know that I'm using those two words interchangeably. The length of credit history, how long have you had a credit card? It's kind of hard for a lender to make a decision on whether or not you'll pay them back on time if you've only had a credit card or one of your credit accounts for, a month, 2 months, 3 months, versus someone that's had a credit card for 10 years, for example. What types of credit do you have? Is it only credit cards? Is it only auto loans? Have you had a home loan, a student loan, any other types of loans or credit types of accounts? And then how new is your credit? How long have you had these accounts for? For example, did you just recently open up 6 credit cards? If so, and I'm a lender, I'm looking at that thinking, well, why do they need another credit card? Are they in financial trouble? This will all help me as someone lending you money make a decision as to whether or not I should lend you more. I then use this video as a credit score broken down to give students an opportunity to see what Bank of America identifies as how a credit score is broken down. And then this image right here from Experian just gives you the quantifiable ranges of how they define excellent credit or exceptional credit versus very poor. Although my time lending, the numbers were a little bit different. I found that anything 720 and above usually afforded you roughly about the same types of rates and experiences, and anything under 600 was usually going to be pretty tough. So my numbers were a little bit off, but this gives you a good starting point too. So what is the impact of that credit score? Well, here we go. With exceptional credit, 800 to 850, based on Experian's graph from below, the best interest rates are going to come to you. You'll have the least amount of lending documents required, and that's because you are a low credit risk. You are somebody that has paid your items on time, every time, and in full. As a result, they want you to borrow money because they know that you are going to be the person to pay them back. As a result, you get lower interest rates and they ask for less information from you. When you get into that very good credit range of 740 to about 800, you're likely to be approved with just about the same interest rates of those with exceptional credit, but you may have a couple lending document requirements here and there. Maybe you missed one payment and have to explain that, and so on and so forth. As we make our way into this good credit range, you'll find that there's more likelihood of you falling delinquent or missing a payment, and you will still probably qualify for most loans, but your interest rate might start creeping up, and it might also require proof of income and residence and other documents. Once we fall into this lower tiered range of 669 down to 580, you're considered a subprime borrower. You'll only qualify for certain types of loans that oftentimes have a lot of stipulations that are attached to it. You'll get higher interest rates, more documents required, and it just starts getting harder. And once you get below that, with that very poor credit, it is really tough to justify borrowing money. And really, usually in this range, the only reason you want to borrow money, hopefully, should be so that you can rebuild your credit score and start showing a positive trend of making your payments on time, every time, and in full. But if you found yourself in this situation, you're probably not going to qualify for lending, or if you do, it is going to be predatory lending to the kindest words that I can say, where it is going to be really, really high interest rates, and they may even require you to collateralize something like put up a pink slip to a car or attach a savings account to it or a retirement account to it. You'll have substantially higher interest rates, and you are going to need to provide them with full income and residential documentation. So here's an example of that A credit versus B versus C. Just as an example, do note that interest rates fluctuate significantly. I'm filming this right now in 2025. Interest rates are hovering anywhere between 7.5% down to 6%. Lots of market volatility and economic changes with Federal Reserve opportunities and whatnot. Not going to get into that, but here's the bottom line. If you have that top tier A credit somewhere in that 740 on up, you are looking at somewhere such as needing a year of tax returns to go buy a house, maybe a month of pay stubs, and you'll likely qualify for a 6% interest rate with about 10% down payment. Now, obviously, we want to have as much down payment as we can afford to put down to get our monthly payment to be lower, but for this example, we'll just go with a 10% down. As your credit starts to creep a little bit lower, you'll find yourself needing to provide more documentation, 2 years of tax returns, 2 months of pay stubs. They use those pay stubs that we looked at 2 units ago to see how much money you've earned year to date from January all the way up until this current date. And then they use the tax returns from the prior 2 years to see is the pay and income consistent so that they can make an educated lending decision. You'll notice the interest rate creeps up, down payment stays about the same. And as we make it to that C credit, you find that the biggest change is the interest rate goes up, and you now need to come down with a greater down payment as collateral. There's only one way to check your credit reports, and there's 3 of them every single year for free without damaging your credit in any way, shape, or form. Now, you can check your credit score many different ways. Like, for example, the place that I bank with allows me to look at my credit score any given time for free, no charge, no impact to my credit report. However, if you want to see your credit report, the only place you can see it is annualcreditreport.com. I've linked this video in here that you can watch as well. The 3 credit bureaus that you would be looking at are TransUnion, Equifax, and Experian. And with those credit bureaus, which we'll talk about shortly here, they will give you 3 different reports with 3 different scores of information and then 3 different total scores as well. So the way that I like to explain this to my students is as follows. When you get a grade in a class, the grade that you get, that just kind of explains everything that happened. That grade is equivalent to the credit score. The credit report is like the grade book. The grade book outlines every single assignment that you turned in. Was it on time? Was it late? Did you do well? Did you not do well? The credit report tells you every single one of those items and how your credit score was figured out. So in order to access that credit report, you want to go to annualcreditreport.com to get all 3 of them for free that you can check one time per year. And there is no other location that you can go to look at those reports without it actually damaging or potentially showing up as a soft inquiry on your credit score. Now, these 3 credit bureaus are all hyperlinked here, and what they are is a company that collects information relating to the credit ratings of individuals, and they make it available to credit card companies and financial institutions so that they can make a determination whether or not to lend you money. I give you 2 different examples. One of them is a student that is at the state college and needs to borrow $3,000 using their credit card with a 22% interest rate. He knows he can only make the minimum payments on that card, and the credit card company is using 2.5% of the balance for those minimum payments. Using the calculator, which I provide and link in here, how many months will it take him to pay off the card, and how much interest would he pay over the time that he is paying that card off? I then use that exact same scenario with a lower interest rate of somebody that had better credit with a 4% interest rate instead of 22% to show the contrast between good credit versus bad credit and the impact that it has on even a small sum such as $3,000. So the most common question that I get from students is, well, that's all great. How do I establish credit as a teenager? And here we go. Here's the first 3 ways to establish credit, and then I'll give you the 4th way, which is ideal in my opinion, but not always accessible to everybody. Way number 1, get a secured credit card. You can go down to a bank of your choosing, probably whoever it is that you bank with or that your family banks with, and then tell them, I'd like to start establishing credit. Do you offer a secured credit card? A secured credit card is where you provide cash up front. Let's say $100. This is what we would call collateral. That $100 that you give to the bank then gives you a credit card. It's an official card. It has like a Visa or MasterCard logo on it. That credit card now has a $100 limit that you can spend. The bank has zero risk because if you make your payments on time, great. They will report it off to the credit bureaus. Your credit score starts to go up. That's all good. But because they have your $100, there's no risk. If you don't make your payments, they'll just take your $100. So the secured credit card is a great way to start getting your FICO credit score to start moving upwards, because FICO does look at secured cards the same as they do as any other credit card. The next step, and this is probably my least favorite, is getting a cosigner. And the reason that I say my least favorite is because if you make poor financial decisions, you could potentially hurt somebody else that really cares about you and took the time to take their credit score and put it on the line for you. So what a cosigner is this. Let's say you go to buy a car and they say you are not eligible to buy this car. You don't make enough money, or you don't have a credit score. If that's the case, well, you're going to need a cosigner. And in that situation, that's where you'll need to get usually a family member with good credit to be a co-applicant. Or you can also see if they're willing to authorize you on the card if you're talking about a credit card instead of using it as a like purchasing a car. So in this case, using a cosigner to purchase a car, however, if you buy that car, that person is as responsible for making the payments as you are. If you miss payments, you're going to hurt the person that trusted you. I've seen it multiple times when I worked at a car dealership, also working in sales, and I saw where a boyfriend and girlfriend would go on a car together and co-sign on a loan, and then guess what? They split up, and now the one person who they trusted can no longer be trusted, and at that time, someone's credit score is getting thrashed, if not both of them, and it gets ugly. The third way is to get a retail credit card. This is you going down to your Target or your Walmart or going to Macy's or fill in the blank other retail store that wants you to borrow money, and they will offer you a fully functional credit card. Usually gets approved at a relatively low borrowing limit if you have a low credit score, and you have to prove your ability to pay it back and build your credit every single time that you are paying it back on time, every time, and in full. Your credit score starts to creep up. It's going to take time, but this is a good starting point. Any missed payments, however, could set you up for a rough start to adulthood. And my fourth and final way, my favorite way, is if you have the ability, if your family has good credit, even before you are 18, oftentimes many credit card companies will allow you to be added as an authorized signer on a parent or guardian's existing credit card. Age requirements do vary per credit card, and sometimes they'll have you have to pay an annual fee in order to do it, but you could be younger and still have access to your parents' spending history and the ability for them every time they pay something off for it to help your credit score. This is something that I plan to do for my kids when they turn 13, and that will give them the opportunity to be building their credit every single month that I pay that credit card off. So the time that they come to be 18 years old, their credit is looking pretty. I then give you a opportunity to look at a credit card website that allows you to choose what would make the most sense for you. And I'm fully aware that there are people that will never get a credit card, but this gives them an opportunity just to look and see what type of offers and opportunities are out there. So what is a credit report and what shows up on it? Because we talked about that earlier with those 3 credit bureaus. Well, I told you that it's like the grade book. And in this case, it's going to share information such as personal info, your credit accounts, your collections items, meaning something if you didn't pay it, you're going to get sent to collections, any public records, credit inquiries. And this credit report is a statement that has information about your credit activity and current credit situation, such as loan paying history and the status of all of your credit accounts. That credit report gets read in various different ways. There's an example credit report right here that is hyperlinked that you can click on to learn more. Now, the different ways to borrow money are varying. The two most common ways are revolving lines of credit, which are times when you borrow money, you pay it off, you can borrow it again. This would be, for example, like a credit card or a home equity line of credit. This is where you have the ability to borrow the money, pay it off, the account stays open, but now you borrow the money again. Versus what's called an installment loan, where you borrow the money, you pay it off, and then that loan disappears. Think of like a student loan or like a home mortgage or a car loan. As soon as you borrow the money, you pay it off, it's gone. That's an installment loan. I have students rank their comfort with credit card knowledge, again, using Pear Deck to slide what their level of comfort is. And then we start talking about how money works when you swipe a credit card. If you were to go to a restaurant, you place your order at the cashier, they're going to ask you cash, credit, or debit. And in this case, we'll say credit. They use this machine right here. It's called the point of sale machine. This is part of a world of business called merchant services. This point of sale machine will digitally communicate the availability of your money with the credit card company as well as with the business where you're trying to swipe that card. So the logo on that credit card shows which payment network is going to process the transaction through their point of sale machine. I like to think of this as this particular card speaks the language of American Express. Does your reader speak the language of American Express? If they both can communicate, then I can use it here. Sometimes if you go overseas, there are certain types of cards that aren't normally used over there. So you need to be aware, especially if traveling, what type of card you have. And in this situation, let's say that it was approved. Your food arrives, it's time to eat. The restaurant got paid to their bank account directly from you spending your money, going through the point of sale machine, borrowing that money out of your credit card account, and then it gets transferred over to the business's checking account, probably. They now get to pay their employees so they too can spend money in the economy to start that cycle over and over again because this is a cycle. But you would think that the cycle is done, and it's not because now you have a debt outstanding. Your credit card now has a balance. Now that you have this bill, you need to pay it off before the due date. And so you can see at the bottom of this, you have new charges on that cycle, that circle over there. As you have the new charges that take place, so the end of the cycle approaches, you have your billing statement that comes up. They say, hey, here's what you owe us. And then they tell you, here's your due date. You need to pay off all of the money you borrowed during that statement cycle by the due date in order to not pay any fees in the form of what's called interest or overdraft or late payments, I should say. Now, with this in mind, if you only pay the minimum balance, which is a portion of what you borrowed, you will get charged interest on whatever you didn't pay from that statement cycle. And if you get charged that interest rate, it's going to be hefty. It can be as high north. I've seen upwards of 26%. If you were to borrow $1,000 for a year at that 26%, we're talking $260 just in fees. That is wild. Do not get stuck in that trap. And that's only on 1,000. Amplify that by 10,000, 20,000. The list goes on. So the general idea is this: don't borrow money you can't pay back on time, every time, and in full immediately by the due date. And you'll get that information in your billing statement. And it's so important because if you choose to use a credit card, you've got to plan on paying that thing off all the way. Otherwise, that interest accumulates and it'll take you months, if not years, to pay it off. And the amount of fees you pay with it is insane. So let's say you didn't even make the minimum payment. Now you're going to have a late fee that gets charged. In addition to that, the interest that's going to get charged. Not paying your credit card in full every single cycle is a dangerous financial catastrophe and trap. If you learn nothing else in this class, this is my opinion, and I do this in almost all my units. Credit cards are a tool solely built to build credit and not to be borrowing money. It is my opinion that credit cards are not a tool to borrow money, but rather just a tool to build credit and every now and then earn a few extra rewards. Now, when I talk about rewards, we can talk about cash back, points, travel. It really just depends on how you spend your money. For example, I know that I'm going to spend money on gas. So I have a card that offers me 6% cash back on the gas pump. I know that it's 5% on the gas pump. I know that I grocery shop every week. So I have a card that pays me back 6% every time I go to the grocery store. It just makes sense. I go to Costco all the time. I have a Costco credit card that makes sure that I'm earning the most amount of points back on that card as well. When I travel, I also have a business credit card that I use oftentimes to rack up points for my business that I run, and that earns me travel rewards as well. So why is there sometimes a charge to use your card? Well, it's because the point of sale machine terminal charges a fee to the business owner. That merchant services fee that gets charged to them for every single transaction that they process, they're pushing on to you. For example, you might at a gas station see that if you pay in cash, it costs one price, but if you use a credit or debit card, it costs another price. That's because that little machine that you swipe or tap your card on is charging a fee to the business, and the business is pushing that fee back onto you. And that wraps up our fourth unit on credit. I'm Max Feldman with the Business Teachers Toolkit. If you're one of my students, feel free to shoot me an email or ask me questions in class. If you're one of my future students or past students, do the same. And if you're one of those teachers out there that are using my materials, I hope that this is helpful for you and your students because it is my opinion this is the most valuable camp class on my campus, and I'm sure it is on yours. All the best.